studying your last two. I swim with tea when they turned in. The staring down to mute and can lend a pole that sunk he died.
We are now entering one of the most important areas of shareholder taxation. Section 15 of the Income Tax Act. At a high level, Section 15 exists to prevent shareholders from receiving value from a corporation without paying the appropriate amount of tax. Think about the relationship between a corporation and its shareholder. A corporation can provide many different types of benefits. It can transfer cash, allow personal use of corporate assets, pay personal expenses, provide property, or advance money through shareholder loans. Without special tax rules, shareholders might try to extract value from the corporation without reporting taxable income. Section 15 was designed to address exactly that concern. The CRA's basic question is very simple. Did the shareholder receive something of value from the corporation? If the answer is yes, the CRA then asks a second question. Should that value be included in the shareholder's taxable income? Section 15 provides the framework for answering that question. Within Section 15, there are two major areas that tax professionals focus on. The first is Subsection 15(1), which deals with shareholder benefits. These rules apply when a shareholder receives a personal benefit or advantage from the corporation. The benefit might involve the use of corporate property, payment of personal expenses, personal use of corporate assets, or other forms of economic value. The second is Subsection 15(2), which deals with shareholder loans. These rules apply when a shareholder borrows money from the corporation and certain conditions are not satisfied. Although both provisions fall under Section 15, they address different situations and have different tax consequences. This distinction is extremely important because accountants must first determine whether they are dealing with a benefit issue, a loan issue, or sometimes a combination of both. Throughout the remainder of this section, we will examine each subsection separately. For now, the key concept to remember is that Section 15 is an anti-avoidance provision. Its purpose is to ensure that shareholders cannot receive economic value from a corporation without the CRA considering whether that value should be taxed. Whenever money, benefits, property, services, or loans move from a corporation to a shareholder, Section 15 should immediately come to mind. It is one of the most important tools the CRA uses to determine whether a shareholder has received taxable income, even when the transaction does not look like traditional salary or dividends. Now, let's take a closer look at Subsection 15(1), which deals with shareholder benefits. This provision is one of the broadest and most powerful anti-avoidance rules in the Income Tax Act. The basic idea is simple. If a shareholder receives a personal benefit from a corporation, the value of that benefit may be included in the shareholder's taxable income. Notice that the rule focuses on value, not necessarily cash. Many taxpayers assume that tax only arises when money is paid directly to them. Under Subsection 15(1), that assumption can be very dangerous. A shareholder can receive a taxable benefit even when no cash changes hands. Let's look at some common examples. Suppose a corporation owns a vehicle and the shareholder uses that vehicle primarily for personal purposes. Or perhaps the corporation owns a vacation property and the shareholder uses it for personal enjoyment. Maybe the corporation pays for a family vacation, covers personal living expenses, purchases personal items, or provides other perks that benefit the shareholder personally rather than the business. In each of these situations, the shareholder is receiving economic value from the corporation. That value may represent a shareholder benefit. The CRA's analysis generally follows a simple framework. First, the corporation provides something of value. Second, the shareholder receives a personal benefit or advantage. Third, the CR determines the fair market value of that benefit. And finally, that value may be included in the shareholder's taxable income. One of the most important concepts in this area is that fair market value matters. The CRA is often less concerned about the form of the benefit and more concerned about the economic value that the shareholder receives. Whether the benefit takes the form of cash, services, property, travel, personal expenses, or use of corporate assets, the CRA will generally ask the same question: how much value did the shareholder receive? If that value was provided because of the shareholder's ownership position, subsection 15(1) may apply. This is why accountants pay close attention to transactions that involve personal use of corporate assets or personal expenses paid by the corporation. Many shareholder benefit assessments arise not because taxpayers intended to avoid tax, but because they failed to recognize that a personal benefit was being provided. The key takeaway from this slide is extremely important. A shareholder can be taxed even when no money changes hands. Under subsection 15(1), receiving personal value from a corporation can create taxable income, regardless of whether the benefit was paid in cash or provided in some other form. For tax professionals, the focus is always on identifying the benefit, determining its value, and deciding whether that value should be included in the shareholder's income under the shareholder benefit rules. Now let's examine subsection 15(2), which deals specifically with shareholder loans. This provision is one of the most important shareholder tax rules in the Income Tax Act because it prevents shareholders from accessing corporate funds indefinitely without recognizing taxable income. The basic situation is straightforward. A corporation advances money to a shareholder and records the amount as a loan. At first glance, there may appear to be no immediate tax consequence because loans are generally not considered income. However, the Income Tax Act imposes special rules on shareholder loans. The key question becomes, was the loan repaid within the required period? If the answer is yes, the shareholder may be able to avoid the shareholder loan income inclusion rules. This is the favorable outcome shown on the left side of the slide. The shareholder receives the loan, later repays it within the permitted time frame, and the loan remains genuinely repaid. In that case, the loan generally remains a loan and does not become taxable income. However, if the answer is no, the analysis changes significantly. When a shareholder loan is not repaid within the required period, subsection 15(2) may apply. Under these rules, the outstanding loan balance can be included in the shareholder's taxable income. In other words, the shareholder may be taxed on money that was originally recorded as a loan. This is why repayment timing is so important in shareholder loan planning. But the CRA's review does not stop there. The CRA also examines the surrounding facts and circumstances. Auditors often review the outstanding loan balance, repayment dates, the source of repayment funds, borrowing patterns, and whether the shareholder engaged in loan cycling arrangements. Loan cycling occurs when a shareholder appears to repay a loan, but then immediately borrows substantially the same funds again. In those situations, the CRA may question whether a genuine repayment actually occurred. Subsection 15(2) is very different from subsection 15(1), which we discussed in the previous slide. Under subsection 15(1), the focus is on benefits received by the shareholder, such as personal use of corporate assets or personal expenses paid by the corporation. Under subsection 15(2), the focus is on loans advanced to the shareholder and whether those loans satisfy the repayment requirements. This distinction is critical. A tax professional must first determine whether the transaction involves a shareholder benefit or a shareholder loan before determining the correct tax treatment. The key takeaway from this slide is that Section 15 contains two separate traps. One trap deals with benefits. The other deals with loans. Under Subsection 15, 2, a shareholder loan can become taxable if the repayment rules are not satisfied, which is why accountants closely monitor shareholder loan balances, repayment deadlines, and any transactions that might attract CRA scrutiny. Understanding these rules is essential because many significant shareholder tax assessments arise not from intentional tax avoidance, but from failing to properly manage shareholder loan accounts.